investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. We had a very interesting week this week with the Dow and other major indices, but fortunately for us, the technical signals are still holding just as we expected them to. And I'd like to point a couple of these out to you, so follow along as I draw my trend lines on the chart. Drawing support and resistance on a chart is not as difficult as you might think. In fact, it's pretty easy. Nowadays, the trading platforms allow you a drawing pencil that is pretty easy to use. Depending on which broker you have, it might be best for you to contact your local broker and ask them for assistance if you need it. But here you can see my pencil. I'm going right from the high back here on March 2nd. And this is for the Dow Jones Industrial Average ETF, ticker symbol DIA. And I'm taking that as my starting point, and then what I'm going to do is extend that to connect as many of these highs as I can. And this is really where you need some artistic ability to just take as many of them as you can, and don't be too specific and say, oh, I need to cross that line, or I can't let any go above or below. Just connect. It's kind of like a mean line where you just drop it right there. And then what I'm drawing for you now is a triangle where I'm starting from this point right here, which is the low on February 2nd, and I'm going to connect as many of these lines as I can and then extend out from there. Now, that is a triangle pattern that is found quite often in many charts, but what we have to watch out for here is when triangles break, either to the upside or the downside, the prices generally continue in the direction of where they break. So for instance, if we break out of this upward line here, then there's a good chance the market can continue to rally and maybe even set some new highs for 2015. However, if the line breaks on the bottom, it could be a very different story. The prices will most likely drop and seek support out where this low is acting as a support right around 170.5 for the diamond. So we really have to watch out for this. Don't take any aggressive long positions at this particular point. We're still waving the caution flag out there because the weekly charts look a whole lot different, and certainly the monthly charts are looking very overextended. So we're not as bullish as you might think at this particular point. Now I can take these same lines and apply them to the S&P. In this example, we're using the Spiders S&P 500 ETF. And you can see that this is an area of resistance right here. This line is a little bit more horizontal than what we saw in the diamonds, but I can still take these lows, connect them, and then extend them out to form my triangle this way. So again, this bottom line, for those of you who are long especially, need to pay attention to that bottom line, because if we break down below that triangle line, we could very well see lower prices. Now, with the Russell 2000, this is a more broad-based index, we can do the same thing, and you'll see that as we drew last week, I had a line of resistance up here, and my forecast was that this gap would fill. That's what this horizontal line is pointing out right there. And yesterday, April 30th, we came right to that line, and today we bounced a little bit. And now we see that there's a gap above the market right here. I'm not going to draw a triangle pattern here because I do think my short-term forecast will lead me up to this gap, and then we could very well see prices reverse. Once a gap fills, there's an 80% chance that the price will reverse, and we'll have to watch that on the Russell 2000 next week especially. Now, the Qs, interestingly enough, are looking a little bit more bullish than any of the other indices. This is the tech sector, and you can see that if I connect some of these lows right here, you'll see that we have higher lows and we also have higher highs. Although this is not a triangle, at least at this point, it's still in an upward trend, and these lines will act as support on the downside and resistance on the upside. So if you are long the tech sector, I would suggest that you trail your stop according to what you see here in support. So if you own tech stocks, chances are their patterns are going to look very similar to what you're seeing in the Qs here, and you just need to adjust your charts along the way and move your stops up. I like manual stops versus using the technology in some of the trading platforms because you can eyeball the support and protect yourself along the way and protect your profits as well. Turning to the VIX, this is, for me, the most important leading indicator. We still see higher lows in the VIX. And if the VIX starts to move up, this is bearish for the S&P, especially because the VIX is inversely related to the S&P, and this is one of the best leading indicators outside of price and volume as you track the trends. The VIX is followed widely by option traders, of course, but the general traders, especially day traders and swing traders, pay very close attention to the VIX. So what I would do is I would suggest that you put the VIX, ticker symbol VIX, and put that on your watch list so that you can track it regularly to gauge the volatility of the market and see whether or not we're bullish or bearish. If you'd like more information about trading and investing, simply go to the Market Guys website. We have a video library right here that will bring you to many other educational videos. These are called market shots. They're anywhere between 3 to 5 minutes long. It's like your daily financial vitamin. We put these together for free for people who are interested, and we continue to build this library each and every month. So stay tuned to the Market Guys, and we will speak with you soon. So long.